Welcome to We live in a world where everyone claims to have discovered the secret to making millions. But what if I told you there was a way to copy the exact investment strategies of billionaires without having to reinvent the wheel yourself? No seminars, no gurus, just proven results. Meet Mohnish Pabrai, the man they call the Warren Buffett of India. He took just $1 million and turned it into over $600 million by simply cloning the methods of the most successful investors of all time. And today, I'll break down his 5 key investing rules that could change your financial future forever. Trust me, by the end of this video, you'll learn how to think like a billionaire investor. So make sure to watch until the very end to discover how you can start seeing real returns. Let's dive in. Coming from humble beginnings, Mohnish Pabrai is an Indian-American investor and the founder of Pabrai Funds based in San Francisco. He currently manages around $1.3 billion in assets. He made a name for himself by following the investing principles of 2 legendary investors, Warren Buffett and Charlie Munger. But he didn't stop there. He also learned from other successful investors like Nick Sleep, Seth Klarman, and Bill Ackman. Although Mohnish has a good understanding of accounting and finance, he freely admits that he's no rocket scientist. Yet he has managed to outperform 99% of professional fund managers over the past decade by simply copying their strategies. But why does he do this? It's because Mohnish is a follower of the idea that when it comes to investing, being original is often overrated. That's right. The path to financial success isn't about coming up with some fancy new strategy or trying to beat the market with complex tactics. Instead, it's about learning from those who have already walked the path before us and made it to the top. By doing so, we can avoid reinventing the wheel and focus on executing tried and tested strategies that have stood the test of time. As Munger famously said, if you really want to hit home runs, it helps to own a bat factory. In other words, instead of trying to be the next Warren Buffett, why not take advantage of his wisdom and knowledge to make smarter investments yourself? Now let's get into the 5 investing rules that will help you do exactly that. Rule No. 1. Cloning. Copying other investors has earned him the nickname the Warren Buffett of India. It might seem counterintuitive, but Pabrai says originality in investing is often overvalued. He openly admits to copying other investors such as Warren Buffett and Charlie Munger, as well as the Lacerno Nick Sleep, whose hedge fund returned 30% annually for 18 years. Why does he do this? Because copying from the best allows him to benefit from their experience and insights without having to go through trial and error himself. After all, why reinvent the wheel when you can simply copy a proven strategy that has already worked for others? One example of this is his investment in Fiat Chrysler. In 2014, he noticed that Charlie Munger's Daily Journal Corporation had invested in the company and decided to follow suit. Despite the naysayers who criticized his decision, Pabrai stuck with his investment and reaped the rewards. In fact, since 2015, Fiat Chrysler shares have outperformed the S&P 500 and other prominent indices. Of course, this doesn't mean that you should blindly copy other investors without doing your own research. But what it does suggest is that you shouldn't be afraid to learn from their experience and adapt their strategies to your own needs. By doing so, you can avoid making costly mistakes and set yourself up for long-term success. So embrace the power of copying and see how it can transform your investment strategy. Rule number 2. Now that we've covered the importance of cloning and investing, let's move on to the second rule of Pabrai's strategy. This is a Gujarati word that means intelligent betting. According to Pabrai, Dhando is at the heart of his investment philosophy and has helped him achieve significant success. He defines Dhando as a method of risk control where the downside is limited while the upside is huge. Simply put, it's a strategy for making profitable bets with minimal risk. To illustrate this concept, let's look at one of Pabrai's investments in an Indian motel business operating in the United States. The motel business had a strong competitive advantage, as it offered a unique service to travelers. On top of that, it was extremely profitable with a 20% return on capital employed, which is a measure of how efficiently a company uses its capital to generate profits. What made it even more appealing was its low valuation. The motel business was priced at a discount, making it an attractive investment opportunity. Pabrai saw potential in the business and decided to invest despite some skepticism from his investors. They were concerned about the company's low growth prospects and its reliance on the hospitality industry, which is known for being cyclical and volatile. However, Pabrai was confident in his investment and he knew that the company's low valuation made it a good deal. Fast forward to today and the company has proved him right. It's still going strong and has shown resilience even in the face of economic downturns. Rule 3. Circle of competence. When it comes to investing, it's crucial to stick within your circle of competence, meaning you should only invest in businesses that you understand well. This rule is often easier said than done, especially in today's world where many companies operate in highly specialized industries that are difficult to comprehend. However, by sticking to this principle, you can avoid making uninformed decisions and potentially losing money. For example, if you don't understand technology, it's probably best to steer clear of investing in tech stocks no matter how hyped they might be. Instead, focus on companies and industries that you're familiar with and feel confident in your ability to analyze. Pabrai emphasizes the importance of simplicity and avoiding complexity in investing. He famously said, If you can't explain it to a 10-year-old, don't buy it. This quote highlights the need for investors to break down complex investment strategies and ideas into simple terms that anyone can understand. By doing so, you can avoid making impulsive decisions driven by complicated jargon or fancy financial models. Instead, you will be able to make informed choices based on a clear understanding of the investment's underlying value. Rule No. 4. Be patient like a crocodile. Next, remember to be patient. One of the biggest mistakes that investors make is rushing into investments without giving them enough time to mature. Pabrai advises investors to be patient and wait for the right opportunities to come along. He likes to keep a portion of his portfolio in cash at all times, which allows him to take advantage of any market fluctuations. During the 2000s tech bubble, for example, he kept a large amount of cash and avoided investing in the bubble. This patience paid off when the bubble burst and he was able to invest in companies at a discounted rate. He typically buys stocks with a 3 to 5 year holding period in mind, which means he's willing to wait for the investment to grow and mature before selling. This approach requires discipline and self-control, but it's crucial for long-term success in investing. Remember, the big money is not in the buying or selling, but in the waiting. Rule number 5. Few bets, big conviction. Finally, let's discuss the importance of diversification. While it's tempting to spread your investments across a wide range of companies and industries, Pabrai recommends focusing on a few high-conviction ideas instead. He usually owns between 10 and 12 stocks at any given time and invests heavily in these companies. By doing so, you're able to maximize your gains when you're right about a particular investment. Of course, this strategy carries some risk, but that's where your due diligence and research come into play. Buffett famously said that diversification is protection against ignorance, which means that investors who spread their money too thinly often lack conviction and understanding in their investments. This can lead to poor performance and missed opportunity. Instead, focus on building a strong portfolio of 10 to 12 stocks that you believe in and hold them for the long term. By doing so, you'll be able to ride out any market fluctuations and take advantage of any growth opportunities that come up. Diversification has its place, but when it comes to maximizing your returns and achieving long-term success, few bets with big conviction is the way to go. Now that you know the 5 investing rules that have made Mohnish Pabrai famous, it's time to put them into practice and start building your wealth. Remember to clone the greats, follow the Dhando strategy, stay within your circle of competence, be patient, and diversify your investments. By following these steps, you'll be on your way to making smart, informed investment decisions that could change your financial future. But our journey doesn't stop here. If you want to learn more about legendary investors like Munger, Fisher, and Templeton, be sure to subscribe to our channel. We've got plenty more videos that could help you become a better investor and build your wealth. So what are you waiting for? Hit that subscribe button and join our growing community of investors. Together, we can achieve our financial goals and build a brighter future. Thank you for watching, and until next time, happy investing.